We begin the markets heading towards those new record highs lifted by a broad group of sectors hitting their own milestones. New all-time highs for tech and discretionary, staples and communication services. Number of others getting awfully close. Pete, that has to be a pretty good sign. I know tech gets a big part of the conversation.
Yes.
Right? It's the
deservedly
sector in the S&P.
Right, deservedly
and they've got
so.
the marquee names.
Yep.
But as I said, discretionary, all-time high, tech all-time high, staples 52-week high. That
one's a little bit
surprising. Services 52-week high, and there's a number of others that aren't all that far away.
Yeah, but it's you led it right, I think, with technology. I mean, that really has been the backbone of what we've been watching over the last couple of months, and it's been extremely strong. And we've talked about the difference of technology, too. We've talked about going from the cloud names to moving over to some of the names that are old school tech, and those continue to perform. When you see Intel on a day like today that's up $2, and Jim and I were just talking about this, it might be up even more than maybe expected. I mean, we knew that the news of last night with Qualcomm and Apple and settlement and all the rest of that, but they really did come through with that, Scott. And it's, oops, that's my ringer. Sorry about that. Usually you tell me to turn the ringer off. But old school tech still is in existence, and that is really the backbone of what we're seeing even today.
All right, Jim. I'm trying to make the point that it's a broad-based move. Yeah. It's hard to hate on a rally that is becoming as broad-based as this one appears to be, right?
Right. And you're even seeing financials. I mean, I'm hesitating before I say this. You're even seeing financials start to show some life. I've been of the belief that that's not going to happen until the yield curve steepens. It's steepening a little bit. But look, it's tempting to get back in financials. I wouldn't be surprised if I'm back in there in the next week or so if this continues. I will say, Scott, and I do not mean to pour cold water on this rally, there is something that's nagging at me, which is we've been waiting for some time for a China trade deal. The details of it to be announced, a signing date to be announced. I've believed, as have others, that it's priced into the market. I'm getting to that point where if we don't see something tangible, like really soon, I think the market is going to say, whoa, is this happening or not? And if we don't get a China trade deal, that's the one big negative that I could see hurting this market. So I really hope this administration just gets it done and soon.
I think fears subsiding, Joe, about the state of the economy has more to do with worrying about this trade deal whenever it's coming. We haven't even talked about the trade deal almost any day in at least this week.
What trade deal?
Yeah, exactly, right. JP Morgan, by the way, they take their GDP forecast for the quarter up to 2.5% from 2%.
Okay. So
that's a big jump.
Month to date, the S&P is up 2.65%. The sectors that are lagging in this month are the sectors that were leading on the belief that the economy was contracting significantly. Consumer staples, utilities, real estate, and healthcare. So it's almost a rate play where you're now seeing strength in stocks that show the growth, have the cyclicality, as the belief that the reservation recession has been canceled. And I think the one sector that is really most telling right now and most important is healthcare. Can we get healthcare to participate? If you get healthcare to participate with a 13% weighting,
no, I mean, look at it right there, okay? Year to date, it's a zero.
Healthcare is, and today's healthcare is trading brutal. Full disclosure, Abbott Labs and McKesson, two names in the healthcare space that I've owned. I've increased today my position significantly in both those names on the healthcare pullback. I think they're quality names.
Let's say, why even, Megan, worry about sectors that aren't getting it done when I tell you that discretionary tech, staples, comm services are great, and then not too far behind. Industrials, just 2% away from their high. Utilities, 3%. Joe mentioned real estate and materials. Yeah, they're pulling up the rear, 4% away from their highs, but it's so broad-based. Why not just stick with what's working? So stop trying to figure out when the dogs are going to participate.
Well, I think what we've seen is a bit of an about-face from the fourth quarter and what was leading during the fourth quarter to what's been leading now. It was really a defensive play in the fourth quarter of 2018, and now we're back into this cyclicals, as Joe was talking about, where it's this view that the economic cycle is going to extend, which is our view as well, and we do think that there is a lot of room to run still for the cyclicals. But I do have to agree a bit with Jim that we don't want to get complacent, and we think that we could see a bit of recycling of risks from the fourth quarter. To me, it feels a little bit like it did in the third quarter when we said the market doesn't care about trade, the market doesn't care about the Fed, and all it took was a trigger The trigger at the time was Chair Powell to get the market to refocus on those risks. And I think that the risks that we're facing now are related to what we had at the end of 2018, but a little bit different. It's not slowing global growth, it's slowing U.S. growth. It's not a U.S.-China trade war, it's European and Japanese trade deals. And those are less potent risks, but relevant to pay attention to.